Hello, everyone, and thanks for coming out to talk about where we are in the commodity cycle. It's going to be a similar talk that I gave last year. It's going to be very similar to that. Some updated slides and a little bit more context about where we are in the commodity cycle. And before we get into it, I'm going to talk about the talk I gave 2 years ago here because I like you guys to have full context, and I like my talks to have continuity and show you that I'm accountable to the things I say and that some of the things I say turn out to actually happen sometimes. These are the publications that I run. Digest Publishing is a publishing company. We have lots of products there that I run, that my partner Gerardo Del Real runs. And we have a couple of other editors now that provide services even in the crypto space. So we cover the entire market. Daily Profit Cycle is our free e-letter. And Resource Stock Digest is also a free resource junior mining newsletter where we have sponsor companies that we help tell their stories. There are lots of information for free. And then these are all my paid products. So Foundational Profits is a monthly macro letter. Hodge Family Office is a weekly macro and speculative newsletter. And Private Placement Intel is just about private placements. All reflect what I'm doing with my own money in those various strata of risk tolerances. So 2 years ago in May 2022, I gave a talk here, and it was titled Macro Bears Hungry for Golden Lollipop with a Uranium Center. And I put this chart up. It ended there in 2021, and I was saying that the CapEx, the blue line is the CapEx in sort of the resource space, and the black line is the CapEx from the S&P companies in the tech space. And basically, when those start to invert is the inversion of the cycle, right? The tech cycle's been running, that's going to start to go down, and that blue line's going to start to go up. And that's the shift of a major CapEx cycle in the market. And so we flash forward 2 years, and you see the black line starting to come down. That cycle is starting to turn, and you see the blue line in the bottom right is starting to go up. So more CapEx starting to be spent on natural resources and commodities, and less CapEx starting to be spent on tech, implying an inversion of the cycle, a long-term cycle I'm talking about. So that was 2 years ago. We did get all-time high gold prices, if you hadn't noticed. We are firmly in a uranium bull market, and so the golden lollipop with the Uranium Center has come to fruition. Last year, I showed you this chart. It said, where are we in the commodity cycle? And I said, you are here, just like those maps in the mall. And this year, it's the same thing. And now we're just here instead of here. You following me? So this is a long-term commodity chart of the CRB Commodity Index, which houses 19 soft and hard commodities: lean hogs, orange juice, natural gas, gold, etc. And it had they go in cycles, commodity super cycles. You've probably heard that term. The last one ran from the mid-90s, 1994 or so, to the great financial crisis in 2008. And it had ebbs and flows along the way, right? So these trees don't grow to the sky. You get mini cycles inside the overall broad cycle. But nonetheless, the last cycle came to an end in 2020 with the COVID crash, and we've been in a new commodities super cycle since 2020. It took off like a bat out of hell, as you can see. It came screaming out of 2020, and now it's sort of consolidating, which happened in the dot-com crash as well, which is why you're now here-ish. So that's zooming in. That's the same chart as here, just zooming into the past 3 years, right? Bottomed in 2020, commodities started taking off. Inflation was transitory in 2021, if you remember. But nonetheless, all the commodities were running up. In a year or so ago, we had inflation peak at 9%, and that's sort of when the commodities index peaked out as well, right? Because it's those commodity prices that are driving the inflation anyway. That's like the input on the CPI numbers. And it's just been consolidating for the past year or so, essentially. That's the right-hand side of that chart there. As the world tries to figure out all the things that you're hearing these macro people talk about, rates and inflation and growth and recession and China and all that sort of stuff, right? And we'll get into some of it, so we'll figure out where we are in the commodity cycle. This is the same exact slide I put up last year. Not all commodities are going to move at the same direction at the same time, and you still have time to build quality positions. That was true last year. That remains true today. Here's the divergence, and here is not all the commodities moving together in the same way, right? So this is just a 2-month chart. Coffee's up 20%. Crude oil's down 15%, right? The CRB, the total CRB index is somewhere in the middle. So we're in the part of the cycle where you have to get good at identifying which of the commodities are diverging higher and which are going to diverge lower and why. This oil down 20% in the past couple of months is a function of slowing global growth, and we'll touch on that in a second as well. So why are these commodities diverging? Why are we getting this commodity pullback? Why is there a lull in the super cycle? Well, it's because of this chart. It's an inverted yield curve, 10s minus 2s, that's been negative for well over a year now. It pretty much ensures that a recession is going to materialize, though it doesn't say necessarily when. You recall everybody was expecting it last year, and then all of a sudden, growth sort of picked up in Q3 after relatively subdued growth in Q1 and Q2. And so this has got everybody sort of screwed up in the head, right? They don't know if the recession is actually going to materialize. But what I would say is that the yield curve is not confused. It's still negative. It's tried to get close to zero once or twice, as you can see on that chart, and it has run away from knocking on that door every single time. This is that yield curve just broken out. So the 2-year on top and the 10-year on bottom, the little spread in between is the yield curve, the 10 years below the 2-year. A couple of points here. The difference between the 2-year and the 10-year, that is the negative inversion. And the other thing I'd say here is, Jerome opened his mouth in December and said, we're going to start cutting rates. The market priced in like 100% probability of rate cuts in March, and yet the 2-year started marching higher. The 2-year is sort of reflective or indicative of Fed policy, while the 10-year is sort of reflective or indicative of, global or U.S. growth. And the 2-year is saying, no, Jerome, you're not going to cut rates yet. And this is one of the reasons why, because you've had relatively stable U.S. economic growth, as I was saying, subdued in Q1 and Q2 last year, but then a strong pop. The revised number for Q3 was up over 5.5%, 5.2% U.S. GDP in Q3 last year. What's going to happen is this is going to roll over anew. So the fourth quarter number will come out, I think, next week, the 25th. This week, it's Sunday. The 25th, the Q4 number will come out. It's going to be below 2%. I'm fairly confident. And so you'll get this talk of slowing growth, recession materializing again. And if you ever wondered why copper can't break out above $4, that's also the reason why. So these are GDP projections. The top one is from the Atlanta Fed, the rosiest of rosy predictions. The green line there on the top, they say 2%. Consensus is somewhere between 1% and 2%. And then the numbers on the bottom there come from Hedge Eye. I would direct your eye to the top line of the right of that table. So Q4 2023 estimated GDP 0.83, and then negative for Q1 and Q2, and not returning to positive and quite positive growth actually late next year, Q3 2024. And so this is sort of the law, that negative 1% growth, that negative 1.6% growth. This is when I'll be buying, the Southern Coppers, the Freeports. I'll be scaling into copper positions because they're going to start to go back up as the economy starts to expand, and that becomes clear to investors. This is the other reason commodities have been going sideways and can't get out of bed. It's the Shanghai Composite Index. It's now at a 3-year low. Major implications for global markets. China can't get out of bed. Same slide from last year, the hope of the recession. We've done the H, we've done the O. Profits have started to erode. At some point this year or in the next 18 months, employment will go, and then we will get some rate cuts, but not until then, because that's how the cycle works. Take a picture of that one. It's long. I'm not going to read it all for you, but it comes directly from the Foundational Profits January issue, and it's basically an outlook for the economy, inflation, and rates, as I see it, for the next 6 to 12 months. Flat to slowing economic growth, inflation remaining sticky high at 3.5%, certainly at 3%, not allowing the Fed to cut because it's nowhere near their 2% mandate. And that's what the last line says there. So if the Fed does cut in the first half of the year, it's because you've got nasty recession materializing that no one's sort of pricing in right now. What does gold correlate with? I thought it went down when rates and the dollar went up here. For the past 6 months, they're all up. Gold's up, dollar up, rates up. Stuff's weird. Takeaway here is that, gold didn't go down as much as it should have gone down in the October-November period when you had the U.S. 10-year running up 30%. I mean, that's not a typical bond move, 30% in 3 months. Come on. And so gold was sniffing that out. It didn't trade as inversely as it typically would, and finished out the year, as we know, at record highs with the dollar regaining strength, at least on the DXY, and the 10-year yield improving as well. So weird times when gold and the dollar and rates can go up commensurately. Nobody talks about gold volatility, so I put a slide up for you. The candles there, GVZ is gold volatility. The orange line is gold. There's no volatility in gold, and that is bullish. Especially the bottom right of that chart there, we've got three-month lows in gold volatility, indicating to me this pullback to 2000 is a time to buy, and gold wants to remain in a bull market. And gold stocks have some catching up to do. This is probably a theme you'll hear a lot here. So gold ran to record highs, up some 67% since 2017. For a large portion of that time, the GDXJ, the VanEck, gold miners ETF, and the GDXJ, the junior portion of that ETF, they kept pace by and large, and did what they do. In 2020, they overshot to the downside. When gold came screaming out of 2020, they overshot to the upside. That's what gold stocks do, right? But yet here we are in 2023 and 2024, and gold at record highs, or at least near them, and these gold stocks not wanting to overshoot yet. That's opportunity in my mind. So opportunity in gold stocks, and everybody wants to know, well, what changes that? What brings the money in? I'm not 100% sure. If I was, I wouldn't be on the stage. I'd be a lot richer, but it's $2,100 gold in my mind, right? It's a firm, round number that's not one that's already been hit. So fresh new highs that bring in, I think, retail and non-resource money into the sector. And I think that happens sometime in the next 18 months. And then I see a lot of gold companies congratulating themselves. So I had this slide in there as well last year, talking about, look how great our stock is. Yes, but, and I was going to put some charts of companies out in the sponsor hall there, but I figured that would be rude, so I didn't, because they most all look like that. They're up for the past, 2 or 3 months, but they're down 30 to 40% over the past year. So lots of opportunity still in the gold space, I would say. I had to throw in uranium. It's not in the CRB commodity index, but I've talked about uranium for so long that I felt I should at least mention it. So one slide on uranium. You've got the candles there are the spot price, which is up 300% since 2020, now at, I think, $104, $105 a pound, U308. And the yellow line is the URA ETF. That's sort of an industry-wide ETF that's been around for a while, so you can get a good deep correlation there. And sort of similar with gold stocks, right? That ETF keeps pace with the spot price of uranium for a while. And then as we get into a firm bull market here in 23 and 24, that spot price of uranium overshoots in a really big way. So as with most things in life, I tell my partner and my wife, truth is somewhere in the middle there. So, does the top line keep going up? Does the yellow line catch up to it? I'm not sure. I think they meet in the middle somewhere, right? But I think still that's upside for uranium equities from where we are currently in the cycle. A lot still to unfold in the uranium market, I think. And then everybody likes the tickers, so a couple minutes on this before I get out of here. I told you at the beginning I invest the entire spectrum, right? Monthly macro, where we're buying things like GDX and Franco-Nevada and large cap stocks, all the way to writing private placement checks into what Rick Rule would call the penny dreadfuls. So a little bit of taste of all of that here at various levels of exposure. And I guess I'll quickly run through it. So we do the whole gamut in gold, at least for sure. Trusted funds like GLD, and we hold a portion of our long-term safe capital in that fund. We own things like GDXJ and the Sprott Uranium ETF, URNM. Those are all in our long-term sort of resource portfolio. Producers and royalty companies, you see triple flag precious metals there. That's TFPM. MP is what used to be Mountain Pass, MP Materials. That's the large rare earth mine in California, now building separation assets in Texas. And then late stage developers, particularly in the uranium sector, I have more names there because they're liquid, they trade well, you can chart them, you can buy in on pullbacks, and you don't have to worry about liquidity because you can get in and out. Uranium Energy Corp, UEC, Denison, DNN, at least in the US. Encore Energy, which I've owned for a while, has done really well. It just came into production in South Texas recently. And then CTGO is on the gold side. That's Contango Ore. They own 30% of a gold project in Alaska that's heading into production with Kinross as the 70% partner. The development side there, Revival Gold is RVG. I've talked about that company for a long time. 6 million ounces of gold in Idaho with past producing infrastructure on site. CRE is Critical Elements Lithium. That's the only fully permitted lithium mine in Canada, currently searching for a financing partner. BRVO is Bravo Mining. That's a PGM gold nickel deposit in Brazil that's very robust, and is going to get more robust because now they're honing in on some massive sulfides that they've identified in the copper and nickel space. And then last line there is the riskiest, Explorcos and generators. And on the uranium side, I have written checks into and continue to own Sky Harbor. That's SYH. Latitude Uranium is LUR. Aldebaran, I think all these companies are here too. Aldebaran is got a massive Altar gold copper porphyry in Argentina. Strong corporate backing. South 32 invested, Route 1 invested. They got 20 million in the bank, and they just started drilling with 4 rigs. That's a really interesting company. Gladiator is Glad. That's on the White Horse Copper Project up in the Yukon, a past producing mine that they're actively drilling. And then Hannon there is a very large, multiple sort of porphyry asset in Peru that they're waiting on permits. That'll probably take a little bit longer to get their permits to drill the asset that they own themselves, but their partnered out project will likely be drilled later this year or early next. So lots of tickers to investigate there, lots of companies to talk to. I think that was my last slide. Hopefully I identified where we are in the commodity cycle, and that was a little bit clear. If you have questions, all those websites have contact pages. I'm happy to give you business cards and chat after the talk, and I'll be around for the next couple of days. So thanks for coming out and listening. I really do appreciate it.